Good morning, everyone. So, we are discussing chapter 2 problems on transfer pricing. So, in this chapter, already we have discussed two problems. So, the next problem, so a company is organized on decentralized lines with each manufacturing division operating as a separate profit center. So there's one company which is operated on decentralized basis where the top level management is not controlling the each and every organization. So each and every department has its own set of controlling measures. So they are not operated by the top level management. So here each and every division manager has full authority to decide on the sale division output to outsiders and other divisions. So each and every division manager, he has a full authority to decide what price they want to charge for the sale of the goods to the outside market, and also for if they want to transfer the goods to other divisions also, what should be the transfer price. So here the division manager has the full authority. So here division C has always purchased its requirements of component from division A. So here they have given information about two divisions, that is division A and division C. So here they are telling that division C has always purchased its requirements from division A, but when informed that division A has increased its selling price to rupees 150. So what this division A has done, they have increased their selling price to 150. The manager of division C decided to look at outside suppliers. So when division A increased their prices, the manager of division C has decided to look an outside supplier. So division C can buy the components from an outside supplier at rupees 135. So what the price charged by the division A is 150, but division C is getting the same goods at rupees 135 in the outside market, but division A refuses to lower its prices in the view of its needs to maintain the return on investment. So what this division A on the negotiation, when the division C negotiated for the price, the division A, when division C negotiated with division A for lowering the prices, the division A refuses to lower its prices as they want to maintain the return on investment. So the top management has the following information. So what is the information? C's annual purchase of the component is 1000 units. So division C, they are annually purchasing 1000 units. So 1000 units they are purchasing. They were always purchasing it from division A. So when the division A was supplying the goods to division C, this was the cost. So variable cost was 120 and the fixed cost rupees 20. So what we are required to do is, we are required to tell them will the company as a whole. So when they have told that that is a decentralized organization, but in this problem we have to, in the first sub question, we have to tell whether the company as a whole will be benefited if the division E is purchasing from the outside market at rupees 135. So even division C, even if the divisions are decentralized, that is not completely controlled by the top level management, but division C is also a part of a company, right? So if division C is purchasing from someone else from the outside market rather than purchasing from A, that is also a part of a company, what effect will be on the company as a whole? When we are not considering divisions, separate divisions, when we are considering all the division as a whole, then what will be the effect on the company? That is one sub question. Next we have to do is, if A did not produce for, sorry, if A did not produce the material for C, so ಇವಾಗ A Cಗೆ ಮೆಟೀರಿಯಲ್ ಮ್ಯಾನುಫ್ಯಾಕ್ಚರೇ ಮಾಡ್ತಾ ಇಲ್ಲ ಅಂದರೆ it could use the facility. So that much of capacity, that much of facilities they can use for other activities. So they have used that capacity and they have earned one cash operating, that is 18,000. So rupees 18,000 they have earned. So now should purchase from outside sources. So if A is earning rupees 18,000 for the facilities, by utilizing the empty capacity, they have earned 18,000 on other activities. Now ivaga should see purchase from the outside sources. Third option is, suppose there is no alternative use. So ivaga whatever the facilities A were using in producing for C, if there is an alternative, they are earning 18,000. If there is no alternative, the A has planned that they will reduce their prices by rupees 20. So what is the total price they are telling? So the total price, whatever the total price they have fixed, they are telling that they will reduce the price by rupees 20. So now should C purchase from the outside market. So now they have telling that if A has no option, if they don't getting any kind of alternative sources, means they will reduce the market price by rupees 20. So what is the market price? The market price is 135. So they are telling that they will reduce the price by 20 rupees, means they will make the price by 115. So we have to tell the suggestions in all these three cases. So let's take the first case, that is the case number 1. Will the company benefit as a whole if division C buy component at rupees 135? So 135 ge come division C, if it is purchasing from the outside supplier, what will be the effect on the company? So what is the total units they want? The total units they want is 1000. So division C wants 1000 units. Division C wants 1000 units annually. So what is the price they are getting at the market? That is 135. So 135 into 1000 is 1,35,000. So purchase cost is 1,35,000. And if we have to consider the companies, that is division A's manufacturing cost, that is the variable cost. The variable cost is 120 rupees per unit. It is 120 rupees. So in the first case we are comparing the market purchase and its effect on the company as a whole. So if we want company as a whole, we have to consider division A's variable cost. So division A's variable cost is 120. So what are the total units they want? 1000. So 120 into 1000, it is 1,20,000. So see here, for supplying the goods from one department to the another department, the main type of cost which is recognized, which is calculated, is the variable cost. Because the fixed cost is, because they are supplying to their own division, to the company's own division, they will not consider the fixed cost. Usually they will consider the variable cost. Here it means they are considering the marginal cost. So in marginal cost, what we will do, we will consider only the variable cost. So here, if the company is manufacturing, the cost will be 1,20,000. But the division C, they are getting it on 1,35,000. So if we compare both of this, the company as a whole will face 15,000 loss. Why? Because if the division A agrees to supply division C, means they will get a profit of 15,000. They will get 1 lakh they will get the goods at 1,20,000. But as division A is not agreeing to supply the goods at 120, they want at 150 only. They have went for outside supplier where they have getting it on 1,35,000. So here the conclusion is the company as a whole will increase a loss of rupees 15,000 if division C bought the component from an outside supplier at rupees 135. If the division A agrees or agree ಆಗ್ಬಿಟ್ರೆ 120 ಗೆ ಪ್ರಾಫಿಟ್ ಸಿಗುತ್ತೆ. They are not agreeing. As they are not agreeing, they will face a loss of 15,000 company as a whole, if we are considering the company as a whole. So next, case number 2. So that is what, if the facilities are used for other activities with a cash operating savings of 18,000, then also C should purchase from outside resources, outside suppliers. So here the purchasing cost from the outside supplier is 135 into 1000, so 1,35,000. So if they are purchasing from department A ಇಂದ ಅವ್ರು ಪರ್ಚೇಸ್ ಮಾಡಿದ್ರೆ department A purchasing cost, variable cost is 120 variable cost is 120. So into 1000 it will be 1,20,000. Next they are telling that they are, if they are using the facilities for other activities. So here we are comparing. So this is for division C and this is of division A. So division C, they are the cost, variable cost is 1,20,000. In addition to this, they are using the facilities for in other activities. In that they are earning 18,000. So if we add this, it will be 1,38,000. So see here. So they are telling that division A, in addition to the variable cost, they will also charge this expenses also. So if division C is willing to purchase from division A, they have to pay for variable cost also, and they have to pay for the expenses they are using on the other activities also, that is 18,000. So the total cost will become 1,38,000. It means 1,38,000 means 1,38,000 divided by 1000. So that is what 138 rupees per unit they have to pay. But division C is getting it on 135. So 135, which one will you choose? Division C, obviously they will choose 135 rather than 138. So here when we compare both of this, 135,000 and 1,35,000 and 1,38,000, 3,000, if they are purchasing from the outside market, they can save 3,000 for the division C. Division C can save 3,000 if they are purchasing from the outside supplier rather than purchasing from the department A. So conclusion, it is suggested that division C should purchase from outside supplier as it is getting profit or saving of 3,000 when compared to division A's selling price. So next, third and the last case is, suppose there is no alternative. ಸೊ ಇವಾಗ ಅವ್ರು ಏನು ಹೇಳ್ತಾ ಇದ್ದಾರೆ, ಏನು ಆಲ್ಟರ್ನೇಟಿವ್ ವೇ ಇಲ್ಲ ಅರ್ನಿಂಗ್ಸ್ ಮಾಡೋಕ್ಕೆ, ಏನು ಫೆಸಿಲಿಟೀಸ್ ಯೂಸ್ ಆಗ್ತಾ ಇಲ್ಲ. ಆ ಕೇಸ್ನಲ್ಲಿ ಡಿವಿಷನ್ ಎ ಅವರು ಏನು ಮಾಡ್ತಾ ಇದ್ದಾರೆ, ಮಾರ್ಕೆಟ್ ಪ್ರೈಸ್ನ ಡಿಕ್ರೀಸ್ ಮಾಡ್ತಾ ಇದ್ದಾರೆ. ಸೊ ಮಾರ್ಕೆಟ್ ಪ್ರೈಸ್ ಏನಿದೆ ಆ ಪ್ರೈಸ್ಗೆ ಅವ್ರು ಏನು ಹೇಳ್ತಾ ಇದ್ದಾರೆ, ನಾವು ಡಿಕ್ರೀಸ್ ಮಾಡ್ತೀವಿ ಬೈ ₹20. ಸೊ ಬೈ ₹20 ಅವ್ರು ಡಿಕ್ರೀಸ್ ಮಾಡ್ತಾರೆ. ದಟ್ ಮೀನ್ಸ್ ದೇ ವಿಲ್ ಮೇಕ್ ದಿ ಪ್ರೈಸ್ ಆಸ್ 115. ಸೊ ಇವಾಗಲೂ ಡಿವಿಷನ್ ಎ ಔಟ್ಸೈಡ್ ಇಂದ ಪರ್ಚೇಸ್ ಮಾಡಬೇಕಾ ಅಂತ ಕ್ವಶನ್ ಕೇಳಿದ್ದಾರೆ. ಸೊ ಡಿವಿಷನ್ ಸೀಸ್ third question is, if there when there is no alternative and the selling price is drops, that is the market price has dropped by 20 rupees. So market price was 135, when it drops by 20 means 115 into 1000, that is 1,15,000. So 1,15,000, so 1,15,000 is the price they have fixed for the goods. So now we have to compare what is the variable cost. So variable cost per unit is 120. 1000 units we want, 120 into 1000, it is 1,20,000. ಸೊ ಇವಾಗ ನೋಡಿ ಕಾಸ್ಟೇ 1,20,000 ಆಗ್ತಾ ಇದೆ. ಡಿವಿಷನ್ ಅವ್ರು ಅವ್ರು ಏನು ಮಾಡಿದ್ದಾರೆ, ಏನು ಅನೌನ್ಸ್ ಮಾಡಿದ್ದಾರೆ, ದೇ ವಿಲ್ ಗಿವ್ ಇಟ್ ಆನ್ 1,15,000. 1,20,000 ಕಾಸ್ಟ್ ಆಗ್ತಾ ಇದೆ. ಅದರಿಂದ ಕಡಿಮೆ ಅವರು ಪ್ರೈಸ್ನ ಫಿಕ್ಸ್ ಮಾಡಿದ್ದಾರೆ, ದಟ್ ಈಸ್ 1,15,000. ಆಬ್ವಿಯಸ್ಲಿ ದಿ ಲಾಸ್ ವಿಲ್ ಕಮ್, ಸೊ ದೇ ಹಿಯರ್ ಲಾಸ್ ಈಸ್ 5,000. ಸೊ ವಾಟ್ ಎವರ್ ದಿ ಸ್ಟ್ರಾಟಜಿ, ವಾಟ್ ಎವರ್ ದಿ ಅನೌನ್ಸ್ಮೆಂಟ್ ಹ್ಯಾಸ್ done by division A or department A, so that is giving them 5,000 loss, because they are selling the goods on the prices which is less than the cost. Here they are not even recovering the cost. So ಈ ಪರ್ಚೇಸ್ ಇಂದ, ಈ ಸೇಲ್ ಇಂದ ಅವ್ರಿಗೆ ಕಾಸ್ಟೇ ರಿಕವರ್ ಆಗ್ತಾ ಇಲ್ಲ, ಪ್ರಾಫಿಟ್ ಅರ್ನ್ ಮಾಡೋದು ಕ್ವಶನೇ ಅರೈಸ್ ಆಗ್ತಾ ಇಲ್ಲ. ಸೊ ಇಲ್ಲಿ 5,000 ಲಾಸ್ ಆಗುತ್ತೆ. ಸೊ ಕನ್ಕ್ಲೂಷನ್ ಈಸ್ ಬೆಟರ್ ಇಫ್ ದಿ ಡಿವಿಷನ್ ಈಸ್ ಸಿ ಈಸ್ ಕನ್ಸರ್ನ್ ಅಬೌಟ್ ದಿ ಹೋಲ್ ಕಂಪನಿ. ಹೋಲ್ ಕಂಪನಿನ ನಾವು ಕನ್ಸಿಡರ್ ಮಾಡಿದ್ರೆ ಡಿವಿಷನ್ ಸಿ ಏನು ಮಾಡಬೇಕಂದ್ರೆ, ಬೆಟರ್ the division C should purchase from the outside market in order to save the company from 5,000 loss. So this is the solution. If you have any doubt, you can ask me in your group. Thank you.